Hello, welcome to Energy Perspectives, hosted by Energy Dialogues, and we're here in San Diego. My name is Jason Bennett. I'm a partner at Baker Botts, and I'm here with John McDougal of Anew Climate and Marisa Hamsik of Chevron New Energies, and we're going to talk about carbon markets. Thanks for joining us. So maybe just to start off, John, could you give an overview of the difference between voluntary and compliance markets? It's sort of central to the whole discussion.
Sure, happy to. So I always like to start off with this, is when you're thinking about carbon markets, it's really divided in at the highest level, compliance and voluntary, with compliance being really a mandated demand governed by some type of state, federal, or even local government that is signed into law, and there is a prescribed compliance scheme for obligated parties, or what they would call in some cases covered entities, to comply with. And there are two different types of instruments in compliance markets. They're called state-issued allowances and also carbon offsets to a lesser degree. In voluntary markets, that's more focused on, again, it's voluntary demand, more centered around corporate social responsibility, environmental social governance, and meeting targets that are voluntarily placed on yourself. There is interplay between the two, and we can discuss that further as we go forward, but it's important to understand just quite simply that compliance market is a mandated requirement for using instruments toward your mitigation or toward a required goal, whereas voluntary is completely self-instituted and using voluntary offsets, only offsets, not allowances.
And there's literally a market, so you go and you buy a compliance offset that allows you to, or you use an offset that potentially reduce the amount that you have to have an allowance for. Another way to say
that's correct. It's another way to say it's a cost containment option for you. So there is, it is a small percentage of what you can use towards your overall compliance, but it is a way to lower the cost of your compliance.
And there's a market for it, and there's standards for that market, and those are pretty clear, as opposed to the voluntary market where there are registries where they're listing offsets, and there's a market for those as well, but they're very different.
Yeah, that's correct. And there's interplay for that. So even on those registries, so for what they call, for instance, California is a large compliance market, I would say the most prominent compliance market in the U.S. today. They actually use those voluntary registries as a resource to register projects that then are overseen by the California Air Resources Board. But yes, there is some interplay. But yes, the voluntary market is just the registries themselves, which are typically nonprofits, that are overseeing the protocols associated with each offset, and then also tracking and the serialization of those offsets. Yeah.
And so each of those registries comes up with its own standards for what qualifies as an offset on that registry. Is there a lot of convergence on that? How does that work?
Across the registries? Mm-hmm. Yes. Typically there are methodologies, from anything from a nature-based project to an engineered project, for example, a landfill project, that you're referring to on the protocols that are peer-reviewed, publicly commented on, and then adopted by those particular registries. And there is overlap across different registries, and you're using those registries as, say, a developer to apply and register your project, which then gives the credibility to your project for third-party buyers to come in and purchase credits on that platform.
So could one project produce both compliance offsets and voluntary offsets, or how does that work?
So there's one of the most very important part of any type of offset project is there is no double counting. Mm-hmm. So to be very clear, even if within a voluntary market, you can't have a group that's selling the offset claim the reduction and the buyer also claim the reduction. It's very important that there's clear ownership of that claim. And so the same way you could not generate a compliance offset with a voluntary offset.
And Marisa, Chevron, I'm sure, is involved in both markets. Maybe kind of tell us all how Chevron looks at these markets, thinks about them maybe differently or the same, and how you view the compliance standards being followed by each. How good are they? Do they meet your standards? How much diligence do you end up doing on these things?
Yeah, sure. So maybe I'll just start to explain kind of what Chevron is doing in this space. So Chevron New Energies is a new division that was launched just over about 2 years ago at Chevron to invest in new business lines that can help Chevron decarbonize its base business and build businesses for the future. So that's hydrogen, CCUS, offsets, and emerging technologies. So specifically in the offset space, what we're really trying to do is build investments, build flexible options for how Chevron is going to meet its compliance and voluntary aspirations, and also potentially eventually help our customers meet some of their aspirations as well, alongside our internal abatement. So it's one of the tools we have in our toolkit to manage our decarbonization journey and our energy transition. And so our thesis is really built around both markets. We are an obligated party where we have compliance requirements in specific jurisdictions. For us, Australia is a very large market, California, also Colombia, places like Singapore, South Korea, and in the future, potentially others. And so where the value proposition for us really is investing in offset types that are eligible in those compliance markets. And as John said, that becomes a cost containment mechanism for us. We're going to have to retire allowances, but if we can secure offsets that are at a discount to those allowances, or we can invest in projects today that are lower cost than what we think the price might be in the future, that creates cost savings for us and a competitive advantage. That is fairly straightforward. There's still a lot of work to be done to understand all of the rules and regulations, and that's part of the real value creation of our business unit, is understanding how the different regulations work in different jurisdictions. On the voluntary side, what we're really oriented toward is building up a portfolio that could potentially meet our future net zero aspirations as a company. We have an upstream scope 1 and 2 2050 net zero target, or net zero aspiration. And we also have a thesis or a belief that what we're talking about is voluntary today. For a lot of those residual emissions, it's possible that they're going to fall under compliance regimes in the future. So our job is really to invest in the highest integrity, highest quality projects that we believe are going to be eligible and legitimately used for voluntary purposes over time, or potentially in new compliance schemes over time, and also to have a diversified portfolio where we're investing in a range of project types, different price points, different geographies, as these markets develop and they're uncertain, and new methodologies coming on these standards all the time.
So do you look at it like there's an array of options for you? I guess internally, if you're doing an activity and it doesn't really fit with where you want to be in a carbon profile in the future, you can always either sort of try to adapt that, change the fundamental activity itself, or move it off or sell it off and not do that activity. Or you can get into projects that provide, you can do sort of carbon abatement on those projects to a point, and then when you reach a point you can't do any more abatement, you can go into projects where you can build up a portfolio over time of projects that are providing you voluntary credits. Or you could go on the open market and buy them. Is that kind of the panoply of options for you?
Yeah, it's a good way to describe it. As companies, and certainly companies in the hard to abate sectors who have millions, tens of millions of emissions to manage and to contemplate, we need a full suite of solutions. That's going to be internal abatement. It's going to be electrification. It's going to be renewable fuels. And we believe, offsets are going to have a role to play in this energy transition, this energy diversification. The art and science of it all is, how much internal abatement is the right amount, both economically, technically feasible, and what's an appropriate use of offsets. That is something that the markets are trying to figure out, and there's some different standards for what we call like demand side integrity, of helping corporates try to understand what is their net zero trajectory and what should the role of offsets be in that. Chevron is not necessarily working with a lot of those standards because they're sort of oriented toward different sectors, not so much the oil and gas sector, but we're asking ourselves that question internally and sort of watching what our peers and what the industry is going to do in terms of the appropriate use of offsets in our industry.
It's a fascinating time. I think as companies look at all these challenges and they're driven not only by their internal goals, but by shareholder demands. And now we have SEC reporting, and we're in a place where it's not, I wouldn't quite call it a voluntary market. I would say voluntary is like when I went onto the United website and I bought my ticket here and it said, do you want to give some money to the carbon offset for this flight, yes or no? Nobody was watching and nobody cared whether I clicked it or not. That's a purely voluntary market. This one is almost like we're anticipating a future where we both want to, as a company, I think companies want to reduce their carbon load, but they're also seeing that we're probably going to be progressing towards from purely voluntary to something closer to compliance, maybe all the way to the compliance in the future. And that's what you're sort of preparing for. And offsets are an interesting way to be a part of sort of getting ready for a future where there are hard to abate, or it would be irrational to try to abate all of them or get rid of the activity itself. So it's an interesting time. I mean, John, your company has acquired, you were saying, and it's sort of an enormous quantity of land for voluntary offsets. Maybe talk about that and talk about the way you see the future shaping up and how you're positioned for that.
Yeah, absolutely. I mean, before I jump into that, I think it's really important that you're right. The voluntary market is very much, I like to call it more of a, and I'm going to steal this from someone who quoted this, is more of a verified carbon market now versus a voluntary carbon market. And we're seeing a lot of programs merging voluntary markets into compliance. Corsia, the airline program, uses voluntary offsets for a mandated compliance requirement. You're seeing Paris, the Article 6, looking at carbon markets to use those for these countries under nationally determined contributions for meeting their goals, using credits or emission reduction credits to meet their goals. So you're absolutely seeing this convergence of voluntary to compliance, and you should be thinking about that if you're going to have that exposure. But yeah, so for Anew, we are a fully integrated carbon offset development company. We saw, and we've been doing this over 20 years, and we saw the market moving in a way that needed this new kind of investment for the massive amount of emission reductions required to meet some of these corporate goals that were coming. And seeing, again, thinking through convergence into compliance. And our company invested with a combination of other companies $1.8 billion into acquiring 1.7 million acres of forest lands that we've now converted over from timbered managed lands to now carbon managed lands. And we certainly wouldn't have done that if we did not see a price on carbon coming into play. And so now we are working through that process of registering those projects with the registries that you referred to, and looking through opportunities to also advance and evolve those programs to provide more transparency, more integrity, and more utility for offsets being used and for companies such as Chevron and their whole suite of solutions they're looking at. One thing I'll add to that is, again, offsets should not be the end-all be-all for mitigation. It should be a complement to what you're doing internally. And it can play a role, and a very important role, to accelerate the journey toward decarbonization for a company.
And so how do you go about compliance on a sort of a large number of timber projects? I mean, I struggle with even what that would look like and how you would do it, and to generate the offsets. Like, what are the things that the registries are asking you to do as part of a methodology, or that you're offering, this is what our plan is to show that we're generating these offsets and how they get generated? Yeah,
I'm glad you asked. So there is actually, we just announced last week during GreenBiz the new implementation of a dynamic baseline tool that we'll be implementing in all of our projects for our improved forest management projects that comply with the protocol or a methodology that, again, has been adopted. It's been peer reviewed, publicly commented on, and it sits on a registry that we can use. Then we're also applying what we call a dynamic baseline tool that's also including technology from satellite imagery to LiDAR to even boots on the ground cruising and looking and making sure that forest stocks actually exist there, and referencing it to other neighboring lands and showing that it's going above and beyond the business as usual scenario to ensure that that change in practice from maybe a harvest regime to now conservation regime that's voluntarily done is actually providing incremental sequestration of carbon and providing that transparency beyond and beyond what we've ever seen before in the carbon markets, to give that integrity to the buyer to make sure that they're actually making an impact with their purchase.
Sort of addressing additionality.
That's exactly right. Additionality. All offsets should be fully additional, go above and beyond business as usual, and the carbon revenue plays a role in the activity and the behavior change of that project.
So Marisa, I would imagine that when you look at both projects and certainly offsets, if you end up purchasing offsets, or you look at projects that are generating something like an offset, or you maybe go ahead and get them certificated as an offset, that sort of compliance has got to be huge for you and your team. Like how does Chevron go about that? How do you think about like what's good enough for us, and how do you think about the difference between going into a project and looking at just buying an offset off the market?
Yeah, so definitely to be clear, when we are investing in these projects, and John just described a really interesting project type, we are definitely looking to be repaid in high quality credits. That's our value proposition. That's different than our trading team. So Chevron also has traders who are in the spot market, who are buying and selling and trading around opportunities as markets shift and move. They're also providing the flow that we need to meet our compliance obligations. So when we were talking before about compliance markets, Chevron's been regulated in California, since the market started, and in other jurisdictions. Australia, as I mentioned, is a big one for us. If we need credits this year, our traders can go out on the market, buy what we need for our compliance obligations, and we retire them against those obligations. But the thesis is, now that Chevron New Energy exists, we can actually put some risk capital against different kinds of projects, longer term investments, things that are going to deliver credits over long periods of time, and can have attractive economics compared to just buying in the spot market over time. So that's what we're aiming for. But we got to know what we're investing in and what we're going to get.
It's a good thing to know.
It's a good thing to know who we're getting in business with, what this delivery looks like over the long term. And absolute cost of entry is genuine carbon reduction, genuine climate benefit, I should say. And there's principles that exist in all of the major registries around additionality, leakage, permanence is critical, no double counting. Right. These things are non-negotiable. That is what generates an offset. And then there's ways you can go above and beyond on certain things that might be required for different project types or project types in certain geographies that give you that much more confidence that the credits are high integrity, that there's clear engagement with communities, benefit sharing agreements, that those kinds of social and environmental benefits come into play for certain project types. More and more, those things are also, we used to call them co-benefits and pay more for them. And they often do command a premium in the market, but that is becoming more and more, again, kind of the cost of entry of just, that's what a high quality project looks like when you're operating in some of these environments. And so we're really oriented toward making sure we are, investing in high quality projects that we can really stand behind.
And so for each of those, though, will you negotiate or even take an equity interest to have sort of direct line of sight in? Negotiate the standards that you want them to follow, and do you come up with your sort of benchmarks internally, or do you look to what Vera, do you adopt some of their standards, or ACR or Gold Standard, whoever you choose, right? Are you looking at those? How do you come up with those?
So internally, we have what we refer to as our investment guardrails or our investment guidance. We currently are focused on investments in the 4 major registries. So we expect our projects to use a methodology on Vera, Gold Standard, ACR, or CAR. A lot of acronyms there. We then do a lot of internal due diligence. We have a technical team in-house of scientists who can really interrogate the biophysical characteristics and the carbon accounting and really understand, will different ecosystems deliver the amount of carbon that we're being told, and how do you model that out over time. Also, we're an engineering company, so we have people that we can draw on to understand the technology-based solutions that we look at as well. We're then also starting to look to new innovative tools that are quite new to the market. I've been in this market almost 20 years, and the explosion of service providers and capital and technology that has come online in the last 3 or 4 years is astonishing compared to what I've seen in sort of the years prior. And one of the big innovations are rating agencies. So we work with rating agencies as another tool in our toolbox. Like if we're looking at a particular project type or a project developer, we can go look at the rating agencies of what their previous projects have done. We're also really interested to see what happens with the ICVCM, the Integrity Council on the Voluntary Carbon Market, and their core carbon principles, which is something that's been discussed for years and is finally being rolled out now in 2024. That is going to start setting a little bit more, well, we'll see, more of a standard of defining what high quality credits look like in the different credit types. Different standards and then methodologies within those standards, or what they call project categories within those standards, will be applying for these core carbon principle labels, and that will help buyers like us assess the quality of those methodologies. And so we look at all of these things to really assess, the integrity of the credits we're investing in.
So with the ICVCM, did I get that right?
You did.
ICVCM would come in and would they look at the project, or are they just going to go to traded offsets and give a rating to them, or how would that work?
Yeah, neither. Well, John, nailed it. John, you can help, but my
please.
understanding is kind of a two-pronged approach where the standards themselves, or what they're referred to as independent standards, I guess.
The registries themselves
apply for CCP adherence, or getting the CCP label, and then the project categories within that. So IFM, afforestation, cook stove. So at like a category level, the ICVCM will be stating, we believe that this project category meets our core carbon principles, but they will not be going at the project level. That's really the role of the ratings agencies, who go very deep at the project level and use all of these remote sensing and other innovative technologies to actually look at whether a project is delivering what it said it was going to deliver at the time it was verified and initially started issuing credits.
And in addition to the registries themselves. So the registry, it's the job of the registry
In
to look at
addition
the project specific, and
So
the
a lot
rating
of people
agencies
looking
do
over these
overlay.
projects.
Yeah, we look, it's important in these markets that there's integrity built in, right? You wanted to make sure that you're actually making an impact and a reduction of removals and occurring. So that's what you're seeing a lot of these last couple years, is this move in play to make sure that that's exactly what's happening. A lot of investment in this space, and what we need to for this market to have a real continued scaling and impact is to create that insurance for buyers like Chevron, to make sure that they're buying something that's real and meaningful. And so that's what we're kind of seeing through right now. And as we get to that point, the idea is that it will become streamlined and scalable and be a meaningful impact tool for meeting our climate goals.
So will that kind of assurance allow you to do less of this in-house, and is that sort of reducing your cost, or is it changing it at all?
Yeah, it's a great question, and I feel like the whole industry is going through this right now, and it's some of the conversations that I'm sure we have all been having with our peers on how much due diligence do you need to do in-house. Is it something that you need to do now, maybe next year, the year after, as Chevron gets better at being an investor and a buyer, and a sophisticated buyer in this space, and then it becomes easier and easier for the nth project because you know what you're looking for? Or do you have to do it for every project because every project is a little bit different? That latter model is not scalable, and also most buyers in the market don't have the luxury of a 10-person origination and technical due diligence team. A lot of the buyers in the market are going to rely on the ratings agencies and these core carbon principle labels, and maybe some cursory due diligence from some other service providers, but then they need to move on. They've got small teams and big goals. So we're going to have to figure out as an industry, and this is the intention of this standardization, to get to a point where credits are commodity-like. I don't know if they're really going to be commodities, although that, that ultimately might be the end game, because at that point they're very scalable and fungible. But there's quite a few steps between the bilateral deep due diligence world we're in now and a fungible, tradable, trillion-dollar market like what we see in the allowance markets.
Yeah.
And I don't know what those steps look like. So, John?
Well, so one really important component too on the integrity side that I think we forgot to mention too as well is that there is a third-party auditor that comes on site and reviews the project proponents' assertions that are made and puts eyes on a project. That's always been built.
But this
into
is
the
through the
system.
registry, right?
This is the registry. So what we're talking about is layering in more and more confidence and integrity into the system, because that's what the market's calling for. Okay.
So my eyebrows kind of went up because I have clients that have projects and they've looked at their project is slightly different than there's no existing methodology, and they said that's okay. Maybe we'll think about we'll create our own methodology. How long does that take? And I tell them 2 to 3 years probably. It involves a lot of environmental consultants. And they just their eyes glaze over and they say that we're not going to do it. Like this, we'll negotiate, directly with the counterparty and we'll move on. Right, and that's moving. While it is, I think, good to have this ultimate, double compliance levels of we know this is a really, really good offset. Doesn't it hurt speed? Isn't that hurting the industry at least in some small way? I know you don't want to trade Peter for Paul here, but there seems to be a trade-off in time.
I would agree. You are making that concession. On time and scale and acceleration. I think we're in a time of reset, of making sure that we have confidence and integrity in the market right now. As we move forward, I think it's going to be the use of technology, the use of more efficiency platforms, maybe more integration of platforms into one. There will be speed that will come with it. I just think it's important and that we spend at least a period of time and keeping the eye on the clock, that we're creating that foundation that gives that level of confidence. But you're right. You're absolutely right. It can be an arduous process, and it does need to speed up to get to the scale we need to.
This is commoditization. That's what you're speaking of, right?
Yeah, and we'll see if we get there. What we need to make sure of is that if we're going to use these markets to do what markets do and find low cost opportunities for emission reductions and removals, and sort of crowd in parts of economies globally that are never going to be regulated, the land use sector, et cetera, markets can be effective in doing that. But what I think you are seeing right now, to avoid the challenge that it sounds like your client had, is you are seeing buyers and investors like ourselves cluster around less than a half dozen time-tested project types where there's existing methodologies, there's a lot of fungibility, a lot of experience, there's imperfection, but we kind of know what we're doing. These are things like IFM, soil carbon, restoration, reforestation, and RED, or avoided deforestation. I've probably left out a couple, but essentially you're clustering around that. Then there's this whole question and whole world of everything else. And we talk a lot about technology-based CDR, carbon dioxide removal, which takes us into conversations around direct air capture, biochar, enhanced weathering, direct ocean capture, and then all sorts of innovative ideas of people who are like, I have a great idea and it seems to take carbon out of the atmosphere. Can I create an offset? It's like, well, an emissions reduction.
How much time do you have?
Emissions reductions do not equal offsets. There is a huge amount of architecture, and it's there for a reason. It's there to make sure that emission reduction is permanent and additional and not double counted. And that is critical because companies like Chevron are continuing to emit and therefore buying an offset to compensate for that. So we need to make sure that offset that we're buying is genuine, so that math works, from a climate perspective. So I think it's an exciting time to see how all of this, the innovation that John was talking about in the technology space, helps us maybe speed up and accelerate all the new types of projects that are going to come online, in addition to helping us make the existing and sort of historical project types more efficient and lower cost.
So last quick question. we come back here a year from now, we sit down, and I say, what changed from the last time we talked? What do you predict? And John, we'll start with you.
Sure, yeah. So I think, I believe, and from the discussions I've had with clients, is that groups are still mobilizing right now and trying to figure out their position on, not only just the carbon markets, but what is their decarbonization plan, right? And then a very simple flow diagram of that is quantify, reduce, and offset, right? And so the third being the offset side, I think as we move closer to 2025, 2030 and beyond, you have a lot of these net zero goals that are set, or low carbon intensity goals that are set, that really, they even say it in these goals that they're not going to get there without offsets. So as we inch closer, and there's more reductions that are done internal within the fence line of these companies or organizations, and they start identifying the residual emissions or the unavoidable emissions as they come closer to their goal sets, then you're going to start seeing the market push and scale and be more liquid, and more groups are going to jump in.
Fascinating. Last word, Marisa.
Oh gosh. Well, like as I've said, maybe, I don't know, but Chevron believes that the future is lower carbon. So that's where we're headed. That's the goal. How we're going to get there is going to require stops and starts, experimentation, a bit of uncertainty. That's true across the range of technical options we have to decarbonize. It's also true just in the little section of the offset market. So I think, hopefully a year from now, we are for sure going to start seeing these core carbon principle labeled credits come on the market, and that will give some market signal and some more buyer confidence to maybe investing in those project types. We're also going to see probably some delays or some project types that are going to take longer, and that's maybe going to give buyers some pause, like, what does that mean for me in those particular project types? I think you're going to continue to see buyers get sophisticated. I think that you are probably going to see some buyers who maybe were in the spot market and were a little concerned about the risks that they were taking on and have moved upstream more into the investment space like Chevron, realizing how complicated and hard that is, and probably shift back a little bit to more of a buyer of credits and less so of an investor. But we'll see. Everyone's kind of experimenting with their business models, how much risk they're willing to take, and how they define quality.
Great discussion. Thank you so much.